Hello viewers, this discussion will cover lapse of equity release contract. Equity release is a contract wherein there is a provider who is generally an insurer. Such provider gives loan to a policyholder. This loan is secured on the house of policyholder. When policyholder dies, from the sale proceeds of such home, this loan is repaid to the insurer along with interest. This loan can also be prepaid by the policyholder during the term of contract, that is before his death. Policyholder can choose to repay loan along with interest before his death as well. This discussion is about what influences policyholder's decision to lapse the policy by prepayment and how to determine prepayment probability. Prepayment is used interchangeably in this discussion with the lapse or early redemption. Also, this discussion will include treatment for probability of policyholder going into long-term care and contracts where further drawdown of loan is also possible. When prepayment happen in equity release contract, generally insurer loses the margin expected to be earned over the life of the contract. So insurer may factor in some early redemption charges in case of prepayments. While setting the prepayment charges, an actuary should consider prepayment charge determination. An actuary should consider prevailing rate of interest, distribution channel used for selling this product, product design, competition, and socio-economic profile of its customers. Prepayments are driven by many factors which are broadly classified in three categories: macroeconomic factors, loan specific factors, and borrower specific factors. Macroeconomic factors are change in interest rates, the difference between number one, the interest rate paid by the borrower, and number two, alternative lower interest rates available in the market is a financial incentive for the borrower to prepay. Housing price inflation. Higher house price inflation encourages borrower to prepay their loan. Conversely, low or negative house price inflation discourages borrower from prepaying the loan. Loan specific factors. Loan to value ratio. Lesser the loan to value ratio, higher can be the prepayment probability, and vice versa. Age of loan, that is time into fixed rate period. Early months in fixed rate contract have lower probability of prepayment and vice versa. Structure of early redemption charges. Early redemption charge methods, size of the charge, and the way that the charges are made may encourage or discourage prepayment behavior. There are some borrower specific factors as well. Marital status of the borrower, One reason that suboptimal prepayments occur is properties being sold to divide assets when a couple divorce. For a divorcee policyholder, there is no further probability of property being sold for the reason of divorce. Postcode, that is the region where the borrower resides. Regional differences in macroeconomic drivers and borrower-specific drivers may impact prepayment probability. Occupation of the borrower. Differences between borrowers due to salary, job, financial literacy, etc. also impact, that is increase or decrease, prepayment rates. Similarly, age of borrower, borrower type, ratio of loan to value, loan to income, other outstanding loans, and moving home due to some reasons are also some borrower specific drivers of prepayment. Predictive modeling can be used to determine the prepayment behavior. Drivers determining prepayment rates such as time since drawdown, financial incentive to prepay the loan, loan size, etc. are identified. Change in these underlying drivers is used to derive expected change in prepayment rates. Let's suppose the base prepayment rate is X%. For the sake of simplicity, let's assume that there are only two drivers, that is time since drawdown and financial incentive to prepay. If the time since drawdown is 1, then its impact on base rate is that it reduces the base rate to its 80%. Where time since drawdown is 2 years, then its impact on base prepayment rate is 90%. Where time since drawdown is 3 years, then it does not impact prepayment rate. Where time since drawdown is 4 years, then its impact on base prepayment rate is that it increases base rate to 110% of its original value. Similarly, when rating of financial incentive to prepay is 1, then financial incentive to prepay loans impact the base rate by reducing it to 90%. When rating is 2, then it does not impact base rate. With increase in rating in base rate also gets increased due to this impact. With these two drivers in place, prepayment rate for a particular segment of policyholders can be computed. For example, for a 4-year-old loan, the prepayment assumption based on above simplified model should be X% into 110%, which belongs to 4th year, into 160%, which is for rating 4, that is 1.76x. In reality, additional parameters and additional levels within the parameters are used. Also, time period specific models can be used. There are data challenges relating to appropriateness of data, completeness of data, and accuracy. These three challenges are to be overcome in order to use the predictive model. Monitoring prepayment rates. A run-off triangle type approach can be used for monitoring prepayment assumptions. Actual by expected ratio for annual cohort of business and calendar year of business are to be included in the run-off triangle. Let's say business was started in 2011. For a business sold in 2011, actual by expected ratio computed is 0.45. For business sold in 2012, for development year 1, actual by expected ratio is 0.67. For development year 2, it's 1.6. Similarly, actual by expected ratio for each calendar year till 2015 and for each development year 1 to 5 can be populated. These ratios can then be monitored over time as insurer gathers more experience. Fitting statistical distribution. Now a frequency table can be constructed with different class intervals of actual by expected ratio. Resulting histogram from such frequency table can be used to determine which statistical distribution closely fits these actual by expected ratios. Such distribution can then be parameterized and hence used for individual capital assessment, internal model, and economic capital computations relating to equity release. Another reason for equity release contract termination is policyholder moving into long-term care home. There is normally some bridging period before any move into long-term care is considered as contract termination. Multiple state models can be used to accurately capture risk of moving into long-term care. It is challenging to calibrate parameters for such model. Long-term transition assumption for every provider will differ based on its own specific experience and circumstances. Long-term care can be incorporated in mortality rates by increasing them with a particular loading factor in order to model the long-term care decrements. This can be done by increasing the QX by a particular percentage, which is X%. This modeling approach implies perfect correlation in long-term care rates and mortality rates for economic capital computation purpose. Because of unavailability of sufficient data on long-term care transition, the stress on long-term care assumption should be more prudent than the stress on mortality for a particular confidence interval. So stress on this part should be more prudent than this part, because data on this part is relatively lesser available. The equity release drawdown products include the facility for policyholders to take additional loans up to limit agreed at point of sale. Valuation of future draws require determination of age dependent probability of policyholder opting for draw in a particular future year and amount of draw. To be taken in a particular future year. These two factors will determine valuation of future draws. Additional risks come from this feature. These risks are further draw amount agreed at the point of sale is independent of fall in property value in future. Future draws typically give rise to an increase in no negative equity guarantee, particularly in conjunction with falls in property value. That's the first risk. Further draws increase loan to value ratio. For example, an additional loan may represent an increase from 30% to 45% of the property value, which is proportionately riskier than the first loan, which is up to 30% of the property value. Loan to value ratio also increases. Future draws can also give rise to profits in favorable scenarios, because they can be equated with new business. In next part of this series of articles will relate to valuation of housing of property using housing price index. In this part we will focus on valuation of property using property indices, that is housing price index. Thank you for watching this video. Any of your queries you can mail me at saket.vashist@gmail.com. I'll be happy to answer any of your query relating to equity release lapses. Wish you all Merry Christmas. Have a great day ahead.